Hey, everyone. Thanks for checking out the Private Lenders Podcast. This is Chris and Jason here. As always, our podcast is sponsored by our mastermind group, hardmoneymastermind.com. This is a community of private and hard money lenders. You can create a free account. Go check it out anytime. And also our lending company, hardmoneybankers.com. Feel free to check us out there as well. Learn a bit about our company, how we market, anything that might be able to help you out. That's what those resources are there for. Okay, so today we're talking about pricing your loans, how to price your hard money loans. And there's a few factors that go into this. First of all, I like to start with just using the example of any business out there at all. Like, how much time, effort, risk are you putting into a business and how much money is coming out? That's where you should start, right? Most people don't. I don't know if we necessarily did at the beginning. We got dialed into that pretty quickly. But we know from experience in some other niches that we've tried, side businesses and stuff, that like sometimes there's too much effort in and not enough money out. I think a lot of that is happening in the lending industry right now, which is one of the reasons why I want to talk about it.
Yeah, well, I think in the lending industry right now, it's kind of a race to the bottom, which is never a good place to be in. And everybody thinks that they need to compete in that place with, oh, well, there's capital out there at 8-1. 9-2, really, really cheap banking institution capital, even cheaper than that, 10-2, things like that. That's just not a winning formula. It's going to be hard for you to grow and scale a hard money lending company with either your own money or other people's money with that. There's just not enough room to just make money. The game plan is to price these deals the way you see fit to make the amount of money that you want on these. It's not like, hey, if you do a loan at 9-2 or 15-5 and the deal defaults, your risk is kind of the same across the board, right? It's a little bit less, obviously, if you have a higher price point, but it's kind of across about the same. The goal is to make the money that you want. I mean, we've always had the mindset and the model of, I would rather do half as many loans for a bigger fee and a higher interest rate and higher points to do half as many loans, right? The last thing you want to do is put yourself in a position, and we're going to talk about this, but put yourself in a situation where you're just competing on price with every other lender out there. You're going to lose if you're competing on price because there's some cheap capital out there, right? You're not going to be able to raise capital that cheap, or you're not going to want to be raising capital that cheap. And you're not going to be making any money. And next thing you know, you're doing multiple deals a month and not making any money. What's the sense of that?
So it's like, even if you win deals, you still lose. That's right. In the game of business. So yeah, let's talk about some numbers. So for a long time, we've been operating based on the metric that we want to net $10,000 per loan, $10,000 per unit during the life of the loan. I did a calculation on our current loan amount, average fees, and it's actually a little bit more than that. It came out to about $11,700. And I'll show you where I got that from. So our average loan amount currently is $175,000, and we charge 3 points plus a couple smaller fees and 13%. Out of that 13%, in most scenarios, the investor, the private investor who invests alongside us, will get 10%, and we're getting 3% servicing spread, right? Which works out to about 23% of every payment that comes in the door. So just doing some quick numbers here. The points plus a few fees at closing, we're looking at about $6,500. If we have a 3% servicing fee, saying that we didn't fund this loan ourselves or part of it, but we're going to talk about some of that example too, we're looking at about $52,3250 if it stays out for the 12-month life of the loan, equaling $11,732. So if you look at some other ways that you might arrive at that number, it's kind of challenging. Like, mind you, this isn't a very big loan in the world of real estate, $175K. We do plenty that are smaller. We do plenty that are much bigger. But you would have to, if you brokered that same loan, say you got a healthy broker fee of 2%, then you're looking at $3,500 compared to $11,700. So it's hard to back that into a solid business model with a marketing plan, with staff and everything else, if you're taking that fee per unit, fee per loan, down to $3,500 instead of $11,700. Now, mind you, on the other side of things, say you funded that loan yourself, and we have a good amount of our own money into loans, and in the future to be much, much more, and that's cool. That's a big part of the long-term plan. That same loan, if you were just lending your own money, is going to bring you in that year about $28,000 to $30,000. Okay, so now going back to the first question, how do you need to price your loans? In the scenario that you're lending your own money, you could charge less to win some more deals, right? Because you don't have to. I mean, make what you can, but you could go down instead of 13-3. You could be 12-2 or 10-2, whatever it might be. And that bottom line profit per loan is still very, very solid. So you have to see what you're working with, the resources that you're working with to lend out, and the money that's going to result at the end of the day.
Yeah, and a few things to look at related to, you don't. It's not like be like, oh, I'm going to lend out at 15% rate and 10 points, right? Because then you're not going to have. Forget deal flow. That you can get deal flow at all numbers. You're not going to have the best qualified borrowers, right? Part of this is, hey, how much can I charge? I'm still competitive for the most part, but also have the right quality of borrower. We're not jeopardizing. We're the most expensive people in town. We're 13% and 3 points, right? And on average, people are probably, for institutional capital, maybe 8 and 1.5, something like that. And then other private lenders, anywhere between 9-3, 10-2, 12-2, 10-3, things like things like that. And it's obviously a different conversation of tactics and things like that in order to customer service to keep all these borrowers. But the point is you want to be kind of competitive, but at the same time make the money that you want. I remember the first deal we ever did, if you've heard that story in one of our past videos, it was a $150,000 loan and we charged 15% and 5 points. We charged 15 and 5 for years, for many years. The first maybe 5 years.
2007, 8, 9, maybe even 10.
Yeah, something like that. For the good part, we were at 15 and 5, and it was great. And I mean, do the math on what 15 and 5 is compared to 13 and 3 is, right? I mean, that's a big difference, right? It's thousands of dollars per transaction. And then imagine even going any lower. Every time we get in our head, it's like, hey, should we try to do more volume and go lower? It's like, no, it doesn't make sense. It doesn't work. Like, I don't want to do a deal for free, and that's what it ends up being. Yes, there's still thousands of dollars, so it's not free, but there's still work that kind of goes into these. But that first deal we did, it had a bunch of prepaid interest on it and things like that. And we made, 10, 11, 12, $13,000 or something like that, depending on how much prepaid interest we had. And when you have a partner, right, or two, it was like, great. We had very little overhead. Chris and I each probably took $5,000 or $6,000 home on one transaction. And that's kind of the transaction that got us hooked on this business. We did one real estate deal and a very low LTV deal. It was very, very passive. And we each made $5,000-6,000, right? Rinse and repeat over and over and over. And that was also the deal that was like, this capital investor is making that as well. They're not doing anything. We need to be on the capital side as well. And then we can make twice as much money. Yep. So the point is trying to figure out kind of, and I'm scared to use the term competitive because I know people listening are going to be like, oh, well, it's competitive at 10-2. That's what I'm going to charge. And to us, it's just not enough money. It's just not worth it doing it at that much. And, we preach all the time of this is a marketing game and you need as many deals to look at as possible. And this is one of the reasons. You know how many deals we pass on because we're at 13-3 and someone says, hey, if you go down to 12-2, I'll accept your terms. We'll move forward. It's like, I can't do it. And we move on to the next one and the next one, the next one. We only have one pricing model. It's 13-3. Keep it super simple. So that's part of our play. And we've done the math and we say, okay, so we got $38-40 million in our portfolio right now at 13-3. Now let's say that entire portfolio, let's say we were able to grow by, 10%, 15% if we did 12-2. I don't know this for a fact, but if you do the math on those numbers and the bottom line net income, it's probably about the same, right? So all of a sudden you're doing significantly more volume and you're making the exact same net income. That's just not the business model that I think any of us want to be in.
No, people fall into it. I don't think they plan on it. And, there's even something to be said for having like a minimum fee or a flat fee sort of model. And not that we do this, but like say if you were looking to net 10,000 per loan at the time of closing, not even on servicing, right? Like you could play with that. And again, we don't do this, but I don't disagree with it necessarily. Like you could be 3 points at 333,000, right? And you make 10 grand, or you could be 1 point and score $1 million deals. You know, you could do that. And most lenders don't, but like there is an argument for that you're backing into the profit you want to make per unit, the amount that goes into the work and what, you know, you spend on marketing and your support staff and all that. So yeah, I think that people go about it a little bit backwards. Instead of getting into it in terms of what they want to take home and how much they want to make for the amount of time, work, effort, they just kind of jump in and say, all right, where's the market? How much am I going to make, sort of thing, and just sort of accept it. And then accept lower margins and say, well, I guess I got to do more deals. And then accept a little bit lower margins and say, all right, I guess I got to do some more deals, right? And all of a sudden you're doing many more units for the same amount of money or even less, which is I mean, that's one of the reasons why we got into this business. Like when we were in the conventional mortgage lending industry before we started HMB in 2007, I had two main problems with it. One was I didn't think there was enough net profit for a loan officer or even for like a company owner necessarily. That was one of my problems with that industry, with that part of the lending industry. And then my other one was like, there are just too many obstacles, too many, you know, hurdles we had to jump over, and documentation and timeframes and everything else, and relying on too many other people in order to close a deal. So it was complete opposite when we got into the hard money lending business. Like both of those problems were solved. We controlled everything in our operation. It was much more streamlined. We made the decisions. We collected the docs. Plus we're making, I don't know, instead of half a point, like, you know, 5 points, we're making 10x. Like we're making a little bit more than that based on the current model, but 5-7 times what we would make on the same size loan in the conventional industry. And I'm like, all right, way better model. It was clear from day one.
Yeah, you also missed the point of, like we talked about earlier, race to the bottom. Everyone's competing with the cheapest cut price. And then whoever was willing to take the least amount of income and make the least commission would win the deal. That's just how it went. And there was 1 million of them that you were competing with. In this space, it's different. You know, there's a lot of folks that we talk to inside the Hard Money Mastermind or that we've done private consulting with in our office. And it's like, this is your business. This is your setup. You do this the way you want. Like, we'll show you a few different ways that we've done it, but like you created it the way you want to do it. If you want to, you know, have $1 million liquid and just deploy that responsibly, and you're looking to make whatever, $200,000 a year off of that, well, you backed into it. You know exactly, hey, you got to charge, you know, 15 and 5, once for a 12-month term. You got to charge 13 and 3, turn the money twice. Like you can figure that out and work backwards to see how you want to do it. So we've always been, you know, and again, it's not like we'll charge as high as you can. I mean, you do want to be competitive in order to get deals, but I would recommend, because there's a lot of people out there that probably think they have more deal flow than and less capital. And if that's the case, if you have less capital, why be cheap on it? Be expensive on it, right? Like if you're like, oh, well, you know, I'm short on capital. Okay, well, guess what happens? You cherry pick the best of the best deal. If you have more deals, supply and demand, if you have more deals than you have capital, you better have a freaking great deal if you're going to put that capital into it. And it better provide you a great return. And again, this is relevant if you're lending your own money or you have capital investors and you're lending out potentially their money or participating with them on deals. Either way, it's the same, right? So I don't know. I mean, one last story. You know, a few years ago, we met up with some of our buddies in a Think Realty event that we were at, and they had a similar size business model to us, or similar size operation to us. You know, we had about the same amount of capital deployed. Well, they started working with cheaper capital on smaller margins in order to scale, right? They wanted to scale. They wanted to, to expand. They're willing to do more deals. They did, they were 4x us, 4 times the amount of volume than we were that following year. And they were like, listen, guys, I know what your numbers are because we had that. Now we're 4x that. We're making less money than you guys are, right? Less money than we are. And also they got a lot of headaches, right? Huge staff, lots of sales reps, lots of this, lots of that. Now, obviously, their business model was a little bit different. They want that the purpose of them doing that is they wanted to scale, and instead of deploying, 130 million or 150, 60 million that year, they wanted to deploy, $500 million, and do it that way. And if that's the type of company you want, by all means. But I know a lot of hard money lenders and private lenders. They either want to responsibly deploy their own money, or a few other family, friends, or other capital investors themselves, or they want a small team, with an accountant and a sales guy and maybe, whatever, an inspector and things like that. So it starts with you of what you want, and, not only of what you want, but also how much money you want to make. That's a good way to kind of end this podcast.
Yeah, I agree. I think you can back into the position you want to be in within this niche, because there are, like we've been saying, a few different ways to do it. But I would start at the end and figure out like what you want that net take home to be. What kind of resources do you need? What does that team look like? What is your schedule going to be like? And map the whole thing out and back into like where you might fit in. And again, like you could be one of those, I want to put out 200 mil a year with a big team and like these slimmer margins, but that's kind of what you have envisioned. Cool. Like if that's your thing, then go for it. And then there's some people that are adamant about being a one person shop. I'm going to lend out, a couple $1,000,000 a year. It's all going to be mine. I don't want to grow any more than that. I don't want to manage people. I don't want to have a big marketing budget. And that's cool too. And it also works like absolutely in between. But yeah, I think that's probably the right way to wrap it up, is start at the end and see what you want that end result to look like, and back into what your company is gonna operate like.
That's right. Well, hopefully you guys enjoyed this week's Private Lenders podcast. Like Chris said earlier on, make sure you go check out hardmoneymastermind.com, set up a free account. There's a lot of really, really good chatter and a lot of really good questions. And that's always been a great way for us to interact with everybody as well, is just go on there, ask any question that you have. There's lots of private lenders, for the most part, almost in every state right now. So that's exciting. We're looking to expand that as well. So, we all have resources we can all share, and deals, opportunities, just knowledge in general. So go create a free account at hardmoneymastermind.com, and we'll see everybody next week.